So this is my paper, Forecasts of the Real Price of Crude Oil Revisited. Do they beat the random walk? This is a reproduction of the paper given at the USAEE, and my co-authors from the Bank of Canada, so the standard disclaimer applies. So the real price of crude oil is an incredibly important macroeconomic variable, right? It matters for policy. Fluctuations of price of crude oil cause large wealth transfers between countries and regions. And they are very important for investment decisions, okay? And there's a very large literature looking at forecasts of the real price of crude oil. And the literature has been able to show gains of over 25% improvements in forecast accuracy by using model-based approaches compared to an average price no change benchmark. So this is pretty remarkable, and it's in striking contrast to the literature on forecasting asset prices. Okay, so the literature considers the real price of crude oil forecastable, and that model-based forecasts are useful. However, the real price of crude oil is a monthly average of daily prices. Okay? And it's been known since Working's work in the 1960s that these, when you aggregate a series, let's say take a monthly average of daily prices, then the monthly average becomes predictable by construction. Okay, so this questions whether or not we're actually comparing against the correct no change benchmark, the correct naive forecast. In fact, we'd expect predictability if the daily real price of crude oil follows a random walk once we aggregate it to the monthly frequency. So in this paper, what we do is we derive the test for predictability for averaged real prices when daily real prices of crude oil follow a random walk. We proposed a test for the optimal forecast in that case, and we reinvestigate the conclusions of literature on the short-run predictability of the price of oil and the usefulness of model-based forecasts. So what is the optimal no-change benchmark under the null of no predictability, right? If the daily real price of crude oil follows a random walk, how do we test forecasts of monthly average data? Well, it turns out we shouldn't be comparing against the average price no-change benchmark. So our setup here is very consistent, is exactly consistent within the literature. Like the forecaster's goal takes all the available, the forecaster takes the information available to them at the beginning of the month, and they want to forecast the H month ahead real price of crude oil, where the real price of crude oil is just given as a monthly average over daily closing prices, right? So the EIA reports the monthly average nominal prices as a simple average over daily closing prices, and this is then deflated by CPI to put it into real terms. So it turns out that if the daily real price of crude oil, the daily closing prices at the daily frequency do follow a random walk, then the optimal forecast of all future real prices, averaged or not, is just the end of month real closing price. Okay, and this is just the nominal value of the closing price in the last trading day of the month divided by CPI. And what this means is that only comparisons against the end of month real price test the null of no predictability. Okay, only the end of month real closing price reflect the test of whether we're rejecting the no predictability for daily prices and for all future average prices. And what this means is that the literature has not been testing against the null of no predictability when they have been forecasting average prices. Okay, in that sense, we need to reconsider the forecast against the end of month no change benchmark to re-examine the tests of predictability. So the question is there a big difference between these two no change benchmarks, right? The optimal under the null of no predictability and the average price no change benchmark. Of course, this applies to both WTI and Brent. And in the paper, we extend it to the US refiners' acquisition cost of crude oil. Well, it turns out there's an enormous difference. Okay, so what this table is showing is the comparison of forecasts between the end of period, the end of month no change benchmark, and the average price no change benchmark. And the top rows here show the mean squared prediction error relative to the average price no change benchmark. So these are the forecasts of the end of period versus the average price. And so what values less than 1 show precision improvements in mean square of the end of period no change benchmark. Okay, so values less than 1 are showing that the end of period no change benchmark are better forecasts. And these are for our different forecast horizon in months. So we're looking up to 1 year ahead for our different crude oil benchmarks. And the bottom rows here show the success ratio. So this is the share of times that our forecast is able to correctly show improvements in directional accuracy. Okay, and what we can see here is that at the 1 month ahead, the forecast improvements can be over 40%. Okay, so this is absolutely enormous improvement in forecast accuracy. Right, in the literature, 25% would be considered exceptional. Here we're showing almost twice that improvement. And in fact, the forecast gains can be significantly different even up to 1 year ahead, suggesting that, even up to 1 year ahead, anything within that horizon, the end of period no change benchmark is a much more stringent benchmark to meet in terms of forecast accuracy. And it turns out that this is entirely consistent both in terms of the magnitude and the decay of the relative forecast gains if the daily real price of crude oil followed a random walk. So both theoretically and in simulation analysis, we can show that this is entirely consistent with the daily real price of crude oil following a random walk, suggesting that it's at very least closely approximated by it. So these are exceptionally large forecast gains that we're getting from the end of period no change benchmark. And it turns out they're incredibly robust over time. So for 100% of the potential ending points for evaluation sample, at the 1% significance level, the end of month no change benchmark outperforms the average price no change benchmark. Okay, so this is significantly increasing the bar for models to claim usefulness. We know that the average price no change benchmark is not a test of predictability of it's not a test if of the daily real prices following a random walk. So despite being rather simple, this is just a different way of calculating the end of period, the naive forecast, the no change forecast. It really has profound implications. It suggests that the standard forecast comparisons against the average price no change benchmark in this literature are actually uninformative because these would actually be expected if the daily price of crude oil is non-forecastable. Okay, and so it calls for a major reevaluation of what we consider to be the findings of these papers and the consensus of these literatures. And we're left with a lot of questions. So actually, can we forecast the real price of crude oil? Do they differ from asset prices? And are any of the existing model-based forecasts useful? So what we did is we went back to the literature. So we're interested in the spot price forecasting. So the monthly average real spot price forecasting, that's sort of been the core of the literature and the most influential papers in this literature. And so for all the different papers, we took the sample, we saw if it was in real time, and we picked the absolute best forecasts from the paper in terms of mean squared precision. So we give a lot of advantage to the papers. We take their absolute best forecast. The largest forecast being like 25% gains, and then we compare them for the exact same sample and the methods and crude oil price series to the end of period no change benchmark, right? So these are relative to the average price, and this is the end of period equivalent forecast. And we can see that none of the existing papers in the literature were able to show a model-based forecast that even came close to the end of month no change benchmark, right? So in the sense, all of these papers concluded that the real price of crude oil is forecastable and that model-based forecasts are useful, but that's because they weren't testing against the null of no predictability. Turns out if we were comparing our forecasts against the end of period no change benchmark, the optimal forecasts under the null of no predictability, then none of those, then the conclusions would have changed, right? None of these models as presented can outperform the end of period no change benchmark at the 1 month ahead. Okay, so this is pretty profound. It suggests that entire literature's conclusions are in question, and this is for the 1 month ahead. So then the question is, is the real price of crude oil special? Is there is the real price of crude oil differ from asset prices in that it's forecastable at short horizons? So what we do is we compare the real forecast, the real price of crude oil. Okay, so this is what you've seen before. And we say, what happens if we made this mistake when we had forecasted nominal prices? So when the literature examined forecastability of nominal prices, they were forecasting the end of month nominal price and comparing against the end of month no change benchmark, because to avoid spurious predictability, right? That's the way that the finance literature responded to Working's criticism in the 1960s and 1970s. So we know when we're interested in nominal forecasts and nominal returns, for example, we need to forecast end of month values. But in cases like the real price of crude oil, right, we don't care about the real price of crude oil next year on December 31st. For running my car, for investment decisions, for monetary policy, we care about the average price of crude oil over the entire next year. So there was a lot of situations where we're interested in forecasting averages. And in that case, it wasn't clear what we should be comparing against, right? And it turns out we really should have been comparing against the end of month real price, right? And in fact, if we had done that for nominal prices, we would have found the same conclusions about predictability, even if there was none in the data. And in fact, this is entirely consistent with what the bilateral exchange rate forecast literature did. So this is the US dollar yen real forecasts and nominal forecasts, right? When that literature, which is more finance oriented, was interested in forecasting real bilateral exchange rates, they forecasted end of month real prices and compared against the end of month real no change benchmark, right? So the real price no change benchmark at the end of the month is, has been used before. It just wasn't used for forecasts of average data, right? The bilateral exchange rate literature wasn't looking at forecasts of monthly average bilateral exchange rates in real and nominal terms. And so these are really placebo, right? This is the S&P, this is the equivalent for the S&P. These are a series that have been shown to be very, very difficult to forecast. And in this sense, the real price of crude oil is very, very consistent with other asset prices, with the evidence from other asset prices. So, despite being a very simple insight, this does have pretty profound implications. And it requires us to actually go back and replicate the existing papers in this literature and to actually be able to do the tests. Okay, so I showed sort of the 1 month ahead, but to test it sort of the 3 month ahead, the 6 month ahead, is there any information at any short horizon? We actually need to go back and do the replications. So you can see my other papers for that. And it turns out there's really no evidence of short-term predictability in the way that those models had been proposed. So you might say, well, look, the real price of crude oil is already very difficult to forecast, and now you've gone and raised the benchmark. Certainly you didn't need to do that. Well, it turns out that the other flip side of this is not only do you lose information when you compare against the average price no change forecast, but you also lose a ton of information when you estimate any model with an averaged series, right? So if you think about the last observed price incorporating all the information in the market, right? In an efficient market, that last observed price incorporates all the information available. And so as soon as we average over any historical daily price, we lose that information. We're diluting it with old information. And it turns out that when you apply disaggregate approaches, when you use daily prices, especially end of month closing price, to forecast average real values, you can almost take any existing model and double forecasting accuracy. Okay, so we have a whole paper on that. We take all the models from literature and we show how they can be extended. And in a lot of cases, you can just get simply by replacing the average price in estimation with the end of month, you can double forecast accuracy. But even then, even with this doubling in forecast accuracy, right, we're increasing our forecast precision, but we've raised the benchmark. We don't know ex ante until we actually go and do the replications, right? And we do the extensions. And it turns out in all the models that we've examined, there's only one case for one series where we use period end price sampling, where we can actually reject the null of no predictability. And I think it was for Brent, and it was using period end price sampling. So you can go check out those papers. And then one of the consensus in the crude oil literature was that future curves aren't particularly useful for forecasting the real price of crude oil. I mean, this was one of the findings that really incentivized looking at model-based forecasts. And it turns out that those same mistakes were made here in those conclusions. If you use the disaggregated data, if you apply period end price sampling, and we showed different ways to basically extract maximum amount of information, turns out future curves are actually really useful at short horizons. They can reject the null no predictability, and they're actually incredibly useful at long horizons. Very substantial forecast gains by 1 year ahead and 3 year ahead. Okay, very useful for forecast horizons that are important for central banks and for investment decisions. And of course, the conclusions of this literature don't just apply to the real price of crude oil literature. They apply to any literature that has been examining monthly average forecasts in real terms. Okay, so these methodological mistakes have also been made in other energy forecast literatures like retail gasoline, and also for the other primary commodity literatures. So really, this really challenges the findings of not only the crude oil price literature, which has sort of been the main forecast literature, but also every literature that has examined all these different applications, suggesting that we actually don't really know a lot about forecasts of primary commodities and retail gasoline. They're really, there's a real big research agenda here, which this is suggesting needs to happen. So to summarize, when you forecast the real price of crude oil, whether you're forecasting a point or whether you're forecasting any average, it's very important to compare against the end of period no change benchmark and not an average benchmark to avoid problems, to actually get the correct conclusions about predictability. And what we see here is that when we do this for the real price of crude oil literature, it overturns the consensus of the forecast of the real price of crude oil at short horizons. And it suggests that model-based approaches are, at least as they've been previously proposed, are not particularly useful. So thank you very much for your time, and take a look at the research, and please feel free to reach out to me. I think you'll see a lot of papers coming out where all these consensuses and across, there's a lot of applications of temporal aggregation, and it raises a lot of important questions for many findings across many literatures, not even just in terms of forecasting. So thank you very much.